We are now going to look at transfer pricing. And this section is very important where we have divisions that supply goods and services to other divisions within the same company. So for example, we have division A and we have division B within the same company, and division A is transferring goods or services to division B. And we need to establish a price for this transfer, and this is referred to as a transfer price. So that's what we are going to be looking at in this section of the lecture. How do we determine the transfer price for the goods or services that are transferred between divisions within the same company? Now, the calculation of this transfer price becomes particularly important when we have divisions that are decentralized. So remember, what does that mean? If the company is decentralized, it means decisions are made at a divisional level by the divisional managers and not at a head office level. So determining the transfer price becomes very important when the company is decentralized and decisions are made at a divisional level. What is the reason for that? Because if decisions are made at a divisional level, those managers are going to be held accountable for the decisions that they make. So managers are going to be evaluated based on their division's performance. And what's going to happen is the transferring division is going to want the transfer price to be as high as possible, because obviously that's where they maximize their profits. So in my example above, Division A is going to want the transfer price to be as high as possible, whereas on the other hand, the receiving division wants the transfer price to be as low as possible, because that's where they will maximize their profits. So Division B in my example is going to want the transfer price to be as low as possible. So because of this, you guys are going to see when we're performing our calculations, we are always going to calculate two transfer prices. We are going to calculate a minimum transfer price, and the minimum transfer price is done from the perspective of the transferring division. So Division A in my example, we calculate the minimum price that they can transfer the goods at without making a loss. And in addition to that, we are also going to calculate a maximum transfer price. And the maximum transfer price is calculated from the perspective of the receiving division, and it's the maximum that they can pay without making a loss. So the reason why we have to perform two different calculations is because both of the divisions want different things. Division A wants the selling price to be as high as possible so that they maximize their profits. Division B wants the selling price to be as low as possible so that they maximize their profits. So the only way we can solve this problem is by calculating a minimum and a maximum transfer price. And then what will happen is the managers of these two divisions will negotiate between themselves, and they will agree on a price that falls in between the maximum and the minimum transfer price. And what's also important to note when we are calculating this transfer price, the fundamental objective is to encourage the divisional managers to make decisions that are not only beneficial to their divisions, but also to the company as a whole. So in other words, when they make decisions, those decisions are goal congruent. They make the best decision for their division and also for the company as a whole. They don't make decisions that just benefit their division, but are not in the best interest of the company as a whole. Then we have different transfer pricing methods. So transfer prices can either be market-based, they can be based on marginal cost, full cost, cost plus markup, or a negotiated price. Now, what we're going to do for the rest of this lecture is we are going to work through two examples. And in these two examples, we are going to cover everything that you need to know about transfer pricing. So let's first start with example 1. So in example 1, you've got Du Toit Limited has two divisions, Division Freud and Division Darwin. Okay, so I was feeling very creative when I wrote this example, obviously. So Du Toit Limited and the two divisions, Freud and Darwin, those are my two cats. So we've got Division Freud produces a product that is transferred to Division Darwin, who uses the product as a subpart in manufacturing a different product. The Freud division can sell the units on the external market for 95 Rand each, and the normal sales demand for this product is 3,000 units. As we read through this example, I just want to take down the important information so that it makes our calculations just now a little bit easier. So we've got the Freud division, and the Freud division can either sell the product externally or to the Darwin division. So just based on everything we told in that first paragraph, we know that they can sell the units on the external market for a selling price of 95 Rand each. And we also know that the normal sales demand is 3,000 units. So let's continue reading, and then we can complete that as we go. So for the Freud division, what are we told? The variable cost of manufacturing the product amounts to 60 Rand, and that includes 4 Rand for packaging and delivery costs. The Freud division incurs fixed costs of 38,000 Rand per annum. The division has a maximum capacity of 5,000 units per annum, and there are no packaging and delivery costs on internal transfers. So let's include all of that information for the Freud division. So the maximum capacity is 5,000 units. We also know that their variable costs are 60 Rand per unit, and that includes 4 Rand for packaging and delivery. And this cost is not incurred on internal transfers. And we also know what their fixed costs are. They've got fixed costs of 38,000 Rand per annum. So that's all of the information we were given about Freud. Then for the Darwin division. The Darwin division incurs 20,000 Rand fixed costs per annum and an additional 120 Rand variable cost per product before the completed unit is sold on the external market at 250 Rand per product. The Darwin division wishes to sell 2,000 products this year, and they can buy the units from an outside supplier at 95 Rand each. However, the division will save 3 Rand per unit in procurement costs if the units are transferred internally. Okay, so let's include all of that information over here as well. So for the Darwin division, they are then going to sell this product on the external market. And we were given a selling price per unit of 250 Rand. And in addition to that, we also know that the sales demand is 2,000 units. If we look at their costs, they have fixed costs of 20,000 Rand per annum, and they have variable costs of 120 Rand per unit. But please be careful, you are specifically told here that this is an additional variable cost. So what I mean by that is it's in addition to the intermediate product or the sub-product that they need to either purchase from the Freud division or the external supplier. So we know we also potentially can purchase this product from an external supplier. And if the external supplier sells them the product, we have a cost of 95 Rand, but we are told they will save 3 Rand if they rather purchase internally. So based on what we've read, we know that Darwin can either purchase this subpart from the Freud division, or they can purchase this subpart from an external supplier. But what's important to note is this variable cost of 120 Rand, that excludes the cost of the subpart, because those are additional variable costs that they incur in order to complete the product before they can sell it on the external market.
So if we go back to the question, you'll see I have quite a few different parts to the required so that we can make sure we cover everything that you guys need to know. So first, let's look at part A of the required. Should the Darwin division purchase the intermediate product from the Freud division or externally? All right, and when we are answering this part of the required, it's important to remember that we can't only make decisions that are in the best interest of the individual divisions. Remember, all decisions must be goal congruent. They must be in the best interest of the company as a whole. So that's what we are trying to look at over here. What is best for the company as a whole? Should the Darwin division be purchasing this intermediate product externally, or should they be purchasing it from the Freud division? What will maximize profits for the company as a whole? Now guys, what we need to do first is we need to determine which cash flows are going to be relevant to this decision and which cash flows are not relevant to this decision. So let's go back to our diagram and look at all of the cash flows, and we can then determine what's relevant and what's not relevant. Alright, so the first thing that we need to consider is whether the Freud division has sufficient capacity for the external sales and also the internal transfer to the Darwin division. Because if they don't have sufficient capacity, we are going to have an opportunity cost. So over here we know that the maximum capacity of the Freud division is 5,000 units. That's the maximum number of units that they can produce. We know that they would like to sell 3,000 units on the external market, and we also know that the Darwin division will need 2,000 units. So you can see we don't have any capacity constraints over here, so we won't have an opportunity cost because the Freud division has sufficient capacity to sell all of the units that they would like to externally and to also transfer 2,000 units to the Darwin division. So we won't have an opportunity cost in this part of the required. You'll see a little bit later as I start adapting the question, we will then have an opportunity cost. So we'll deal with that in another part of the required. But for now, you can see we definitely won't have an opportunity cost. So what we need to do is compare what will it cost the company if this intermediate product is purchased externally versus what it will cost the company if the intermediate product is purchased internally from the Freud division. So guys, obviously, if the intermediate product is purchased from the external supplier, the Darwin division is going to pay 95 Rand per unit, and now obviously going to purchase 2,000 units because that's what they can sell. So that's what it will cost them to purchase the intermediate product from an external supplier. If we go back here, you can see cost if the units are purchased from the external supplier is 95 Rand per unit multiplied by 2,000 units. We have a cost there of 190,000 Rand. Then we need to compare that to the cost if the units are purchased internally from the Freud division. Now, it's important to note here, guys, obviously the Freud division is going to charge the Darwin division for this intermediate product if the Darwin division buys the product from the Freud division. So we are going to have a transfer price over here. Now, let's assume for now, we don't know what that transfer price is. Let's assume for now that the transfer price is 100 Rand. It's important to note that this 100 Rand will obviously be income to the Freud division. So it will increase the profit of the Freud division because it's income to the Freud division. And it will be a cost to the Darwin division. So it will decrease the profit of the Darwin division. However, from the company's perspective, there's no actual cash flow from the company's perspective because these two offset each other. It's income in the Freud division and it's an expense in the Darwin division. So from the company's perspective, it's cash neutral. There's no cash inflow or cash outflow. This is just a transaction that happens between the two divisions. So that's not relevant and should not be taken into account in our calculation. And you can see that discussion over here. If the units are transferred internally, the transfer price paid for the intermediate product is a cash inflow for the Freud division and a cash outflow for the Darwin division. So in other words, it is cash neutral from the company's perspective and is therefore not taken into account in our calculation. From the company's perspective, there's no cash flow. It's income for the Freud division, it's a cost for the Darwin division, and those two offset or they cancel each other out. So we don't take that into account. However, what we do need to take into account is if the Darwin division is going to buy this intermediate product from the Freud division, the Freud division is obviously going to have to produce the product. So if they have to produce that product for the transfer, their variable costs are going to increase as a direct result of the internal transfer. Think about this logically. If they only produce 3,000 units for the external market, then their variable cost will be 60 Rand per unit multiplied by 3,000 units. However, if they also have to transfer 2,000 units to the Darwin division, then their variable costs are going to increase. And that is a proper cost from the company's perspective. So that is what we need to take into account. We need to compare the increase in costs for the Freud division to what it would cost to purchase the components externally, and then we can make our decision. So what's going to happen? If the Freud division has to transfer 2,000 units to the Darwin division, their variable costs are going to increase. But be careful, the variable cost on the internal transfer is not 60 Rand because we know that 4 Rand is going to be saved on internal transfers. On internal transfers, they will not incur the packaging and delivery cost. So the variable cost on internal transfer is only going to be 56 Rand per unit multiplied by 2,000 units. Okay, so the variable cost for the Freud division, 56 Rand per unit multiplied by 2,000 units, 112,000 Rand. That cost is relevant because the cost is incurred as a direct result of the internal transfer. If the internal transfer doesn't happen, if these units are purchased externally from the external supplier, then the Freud division will not incur these costs. The Freud division will only incur the 60 Rand per unit multiplied by the 3,000 units that they sell on the external market. They won't incur this variable cost for the 2,000 units if the product is purchased from an external supplier. They will only incur this cost if the product is transferred internally. All right, now you can see those are the only cash flows that we are taking into account in the calculation over here. But let's just discuss why everything else is not relevant. Why are we not taking into account any of the other cash flows? If we go back to our diagram over here. Sorry, once again, let me just clean this up before I start talking to you guys, otherwise it's just a little bit too messy. Okay, so firstly, with the Freud division's variable costs, we've only taken into account the variable costs that will be incurred on the internal transfer. So the additional variable costs that the Freud division will incur if they transfer 2,000 units to the Darwin division, because that's relevant to this decision. It's an extra cost that the division will incur as a direct result of the internal transfer. However, they will also incur variable costs of 60 Rand per unit multiplied by 3,000 units for their external sales. But it's important to note that regardless of whether this component is purchased from the Freud division or whether it's purchased externally, the Freud division will still incur variable costs of 60 Rand per unit multiplied by 3,000 units, regardless of what happens. So that's not relevant and is not taken into account. The only relevant portion is the increase in variable costs as a direct result of the internal transfer. So in other words, the variable costs incurred to produce the additional 2,000 units. The variable cost for the 3,000 units is not relevant. It's the same regardless of whether the component is purchased internally or externally. And the same logic applies to the fixed costs over here. And the same logic actually applies to the fixed costs of both divisions. Let's first look at the Freud division. Regardless of whether they produce 3,000 units or they produce 5,000 units, the fixed costs are still going to be 38,000 Rand. Because remember, fixed costs don't change with a change in volume. So regardless of whether they transfer the 2,000 units to Darwin or Darwin buys the units from the external supplier, the fixed costs will still be 38,000. They don't change and they are therefore not relevant. The same logic applies to the fixed costs of the Darwin division. Regardless of whether the Darwin division buys the component from the Freud division or the external supplier, their fixed costs are still going to be 20,000 Rand. There is no change in the fixed costs, so it is not relevant and it's not taken into account in our calculation. What about the variable cost of the Darwin division of 120 Rand per unit? That's also not going to change. The variable costs of the Darwin division are going to be 120 Rand per unit multiplied by 2,000 units. It doesn't matter if that component is purchased from the Freud division or from the external supplier. The variable cost in total is still going to be 120 Rand per unit multiplied by 2,000 units. So because there's no change in the cost, it's not relevant and it's not taken into account in our calculation. Then the only thing that I haven't discussed with you over here is the sales of the two divisions. And once again, the same logic applies. Let's first look at the Freud division. So with the Freud division, externally, they are going to sell 3,000 units for 95 Rand per unit. And those sales are going to be the same regardless of whether they transfer the intermediate product to the Darwin division or if the Darwin division buys it from an external supplier. It doesn't change. So because there's no change in the external sales, it's not relevant, it's not taken into account in our calculation. And the same logic applies to the Darwin division. The Darwin division is going to sell 2,000 units at 250 Rand per unit. Regardless of whether they buy the component from the Freud division or the external supplier, they are still going to sell 2,000 units at 250 Rand per unit. So there's no change regardless of what happens, and therefore the sales, the external sales for both divisions is not relevant to our calculation. All right, so you can see that discussion over here. The only cash flows that are relevant to this decision are the additional costs that will be incurred by the Freud division if the units are manufactured internally versus the cost that will be paid to the external supplier if the units are purchased externally. And it's very important to note, you can see here, guys, remember in this example, we did not have an opportunity cost because there were no capacity constraints, but you do always need to consider whether there is an opportunity cost, and it should be taken into account over here. Remember, you must always show your calculations. So on the next page, you can see here is the calculation for the opportunity cost. We know that the Freud division has a maximum capacity of 5,000 units. We know that the internal demand is 2,000 units. The Darwin division requires 2,000 units. So that leaves them with spare capacity of 3,000 units for their external sales. And they want to sell 3,000 units externally. So they have enough capacity for their external sales and also for the internal transfer. So we don't have any shortage. So because there are no capacity constraints, there is no opportunity cost in this part of the required. Remember, always just show those calculations. All right, so we don't have any opportunity cost over here. So what is the cost to the company if the units are transferred internally? It's going to cost the company 112,000 Rand. If the units are purchased externally, it's going to cost the company 190,000 Rand. So we can see it is cheaper for the units to be transferred internally. And the company will have a saving of 78,000 Rand if the units are transferred internally. So we can now answer the required. Should the Darwin division purchase the intermediate product from the Freud division or externally? They should purchase from the Freud division because it will save the company 78,000 Rand. And you can see here is your conclusion. It is therefore in the best interest of the company as a whole for the unit to be transferred internally and not purchased from the external supplier. And it's important to note that this should continue for as long as the Freud division has spare capacity. If the spare capacity runs out, then this calculation will need to be re-performed. And we'll look at that a little bit later in the lecture.